Welcome back. We will now discuss the sublease. This is a small topic but very relevant. Let's understand it. So when a lessee releases the asset to a third party, then it's called sublease. Means the lessee is releasing the asset which he took on lease. Let's understand this with an example. There were two individuals, X and Y. X owns a helicopter which he was not using very frequently and want to lease it to someone else. Y was very much interested in X helicopter and wanted to take it on lease. Y offered a very reasonable lease rent to X and they executed the lease contract. Now in this contract, Y is a lessee and X is a lessor. X will do the lessor accounting. Means if X conclude that the contract is a finance lease, he will de-recognize fixed asset, recognize lease receivable and will recognize periodic interest income. However, if X concludes that it's an operating lease, then he will only recognize lease income. On the other hand, Y is the lessee and will do lessee accounting. If Y conclude that the transaction is eligible for exemption and he wants to avail the exemption, he will recognize the lease rent as an expense either on a straight line or any other reasonable basis similar to erstwhile leasing standard. But if Y conclude that transaction is not eligible for exemption, then he will recognize ROU of asset, lease liability and periodic interest expense. Here it is important to know that IFRS 16 has restricted the low value exemption in case of sublease. In our case, since we are dealing with asset like helicopter, it's certainly not going to be a low value exemption. After few years, Y realized that maintaining and traveling with this helicopter costing him a lot of money. And he was looking to either cancel the lease or to sublease it to a third party. That is when Y met P, who was running a logistic company and was willing to take the helicopter on lease. Post couple of meetings and discussion, Y and P executed the lease contract. Now this is a sublease contract where P is a sublessee and Y became an intermediate lessor. Means Y is now both a lessee and a lessor, but not the primary lessor. X will remain the primary lessor and we can call him the head lessor. Interestingly, since Y is both lessor and lessee in this overall transaction, he need to do the accounting for both lessee as well as lessor. However, his lessor accounting will be very much linked to the accounting he is doing as lessee. Means if Y has availed the exemption and was recognizing only lease expense, he as an intermediate lessor will account for periodic lease income. On the other hand, if Y has not availed the exemption and had recognized the ROU and lease liability, then he need to assess if the transaction with P is a finance lease or an operating lease. If it's a finance lease, then Y will de-recognize the ROU and recognize the lease receivable and periodic interest income. And if it is an operating lease, then Y will only recognize periodic lease rental income. P as a sublessee will also assess if the transaction is eligible for exemption, and if he wants to avail the exemption, he will recognize only the periodic lease rent expense. But if P conclude that transaction is not eligible for exemption, then he will recognize ROU of asset, lease liability and periodic interest expense. Let's now put some numbers to this example and see how the accounting entries will flow in the books of X, Y and P. So in this table, I have put the relevant terms of contract between X and Y, and in this table between Y and P. In this example, it is assumed that none of the lessees can avail low value exemption and both the head lessor and intermediate lessor has considered the transaction as finance lease. Let's first take the arrangement between X and Y wherein the lease period is 8 years, lease rent is 100,000, useful life of truck is 8 years, IRIL is 5%, unguaranteed residual value is 100,000 and the carrying value is 700,000. So first X and Y need to compute the lease liability and lease receivable. In this table, lease receivable for X is computed based on the PV of future lease rental of 100,000 per annum at a discount rate of 5% for 8 years. Unguaranteed residual value is also included in the lease receivable. And in this table, lease liability for Y is computed based on future lease payments of 100,000 per annum at a discount rate of 5% for 8 years. So initial recognition by X will be to recognize lease receivable of 714,005 and de-recognize the helicopter from the books with its carrying value and recognize the delta as gain. At the year end, X will recognize interest income and receipt of the first installment of lease rent. Let's go to Y now. Y will recognize the ROU of asset and lease liability on initial measurement. And at the year end, it will recognize the amortization of ROU and interest expense along with payment of first year lease rent. Now Y has subleased the helicopter to P and they will compute the lease receivable and lease liability. So in this table, Y has computed its lease receivable and in this table, P has computed its lease liability. On initial measurement, Y will de-recognize the ROU asset based on the WDV at the end of year 3. This is how the WDV is computed after reducing 3-year amortization and the delta will be the gain for Y. At the year end, it will recognize interest income and receipt of first year lease rent. P on day 1 will recognize lease liability and ROU and at year end, it will recognize amortization of interest expense along with first lease rent payment. And now I believe it should be very clear to you that how the computation will take place and what all accounting entries need to be passed in the books of all the 3 parties to the contract.